Ladies and gentlemen, good day and welcome to Kolte-Patil Developers Limited Q2 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shiv Muttu from Adfactors PR. Thank you, and over to you, sir.
Yeah, thanks. Good afternoon, everyone, and thank you for joining us on the Q2 and FY2024, Q2 and H1 FY2024 results conference call of Kolte-Patil Developers Limited. We have with us today Rahul Talele, Group CEO, and Dipti Rajput, Vice President, Investor Relations. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available in the Q2 and H1 FY2024 results presentation that has been sent out to you earlier. I would now like to invite Mr. Rahul Talele to begin the proceedings of this call. Over to you, Rahul.
Rahul, sir, you can go ahead, please.
Good afternoon and a very warm welcome to everyone present on this call. Thank you for joining us today to discuss the operating and financial performance of Kolte-Patil Developers Limited for Q2 and H1 FY2024. I would like to begin by sharing with you our views on the real estate environment, followed by an overview of key developments of the quarter. After my comments, Dipti will take you through the key financial highlights. We then look forward to an interactive session with participants where we will take your questions and suggestions during today's call. I take this opportunity to wish you and your near and dear ones a very happy Diwali and joyous New Year. Let me begin by sharing a few thoughts on Indian economy and the real estate market broadly, as well as our outlook on the key markets in which we operate. It is clearly evident that India is emerging as an increasingly important component in global geopolitical equations and is very likely to sustain its status as one of the fastest growing economies globally over the next several years. In the current regime, there has been an implementation of structural reforms and channeling of investments from domestic as well as foreign investors into development infrastructure and human capital. As India progresses to a developed country status, we anticipate the sustained progression of our growth trajectory and the emergence of real estate sector as a key contributor, with the supply gap of quality real estate getting closed over the years. Based on the recent government policies and legislation, along with the incremental boost from incentives, there has been a substantial and structural uplift in the demand for real estate. The improving landscape is based on synergies from policy measures and market dynamics, working hand in hand to create positive visibility for strong developers that have built sustained customer outreach and solid reputation. From Kolte-Patil's perspective, our targeted markets are experiencing robust demand, showcasing resilience underpinned by increasing employment opportunities, expanding physical infrastructure, and improved connectivity. We have built a diverse customer-centric portfolio of offerings that are slated to capitalize on favorable market trends. Covering mid-income and luxury segments, we have continued to fulfill customer aspirations over the years, supporting their desire to lead happy and comfortable lives. Our recognition of the customer's expectations has allowed us to build a brand that is associated with trust and confidence. We have successfully launched new projects while continuing to witness strong visibility across our sustenance projects. In H1 FY2024, we registered new area sales of 1.91 million square feet with aggregate value of rupees 1,333 crores, higher by 63% and 64% year-on-year respectively. In Q2, new area sales was up 75% year-on-year, 2.98 million square feet, and sales value increased by 72% year-on-year to rupees 632 crores. Average realization remained stable at rupees 6970 per square feet. Also importantly, collections from customers during H1 expanded by 12% to rupees 985 crores, creating the requisite liquidity to expedite project execution. We believe that reaching sales volume of almost 1 million square feet in what is traditionally a weak quarter for customer demand is a significant achievement. Given the demand momentum, increasing brand recognition, available sustenance inventory, in addition to the upcoming project launches, we are confident of meeting our stated pre-sales guidance of rupees 2,800 crores for FY24 and rupees 3,500 crores in FY25. As you know, during H1, we launched projects with the GDV of 1985 crores, which contributed 55% of sales value for H1 FY24. The Life Republic sales volume stood at 1.3 million square feet in H1, highlighting the strength of our flagship project that has continued to gain traction with home buyers evaluating real estate options in the Hinjewadi micro market. Several other project launches remain on track and will contribute to maintaining the momentum in the future as well. Meanwhile, our robust business development engine has enabled 6 new project acquisitions with aggregate sales value of 3,450 crores. These projects provide additional visibility in Pune, western suburbs of Mumbai, as well as entry in the central suburbs of Mumbai and Navi Mumbai market within the Mumbai metropolitan region. On the deliveries for the year, we are confident of closing the year with 3 million square feet in FY24, translating to revenue of rupees 1,500 crores. In current quarter, profitability has been impacted on 2 counts: impairment of goodwill and compensation for the land in Life Republic project. This goodwill generated earlier on account of merger of a subsidiary has been impaired to the extent of rupees 12 crore 38 lakhs. This is revenue recognition for the underlying project, impacting net profit. Rupees 6.78 crores compensation for land in Life Republic project is owing to land sale deed reversal in the Life Republic project that was earlier recognized as revenue. This has an impact at EBITDA level and in the net profit. Going forward, we see a positive long-term outlook for the sector and our business as the country emerges as a key driver of global growth. During this period, we see real estate sector expanding its contribution to India's progress with likely demand growth across segments based on customer preference for reputed brands and our strong positioning across the targeted geographies. We see consistent stakeholder value emerging from the business in the years to come. With that, I now hand over the proceedings of this call to Deepti Rajput to provide a financial overview.
Thank you, Rahul. Good afternoon, everyone. Wish you all a very happy Diwali and a prosperous New Year. I will now briefly take you through our financial performance for the second quarter and half year ended 30th September 2023. Based on PCM-based accounting, in Q2 FY24, we clocked revenues of rupees 198.2 crore as compared to rupees 123.3 crore in Q2 FY23, and for H1 revenues stood at rupees 769.3 crore. EBITDA for the second quarter and half year stood at 3.5 crore and rupees 94.6 crore respectively. Net loss for Q2 FY24 stood at rupees 25.3 crore and net profit for H1 FY24 stood at rupees 20.6 crore. Rahul has already explained the 3 key factors that have impacted profitability during the year. Here we would like to remind you that recognition of revenue and profits are dependent on the timing of project completion based on statutory accounting guidelines. Our net debt to equity stands strong at 0.05x as on September 30th, 2023, and the operating cash flow for H1 FY24 stood at rupees 182 crores. We expect to report improved performance across operational and financial parameters for the remainder of the year. We remain committed to enhancing sales performance, timely execution, and generating strong cash flows, which will continue to drive P&L performance over time. On that note, I conclude my opening remarks and would now like to ask the moderator to open the line for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. We will wait for a moment while the question queue assembles. Our first question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead, sir.
Hi, good afternoon and congratulations Rahul and Dipti on a great number. Rahul, coming back to our business development pipeline, see so far this year we have guided for say around 8,000 crore of business development, but so far we have been able to do only 3,450. Still we are lagging, so and largely we have been able to do whatever market, but in Pune and Bangalore we are lagging. So can you give some more color on where exactly we are and how confident of doing say 4,700 crore pipeline, business development to be closed in second half? And second thing, on MMR, since we have reached our target, so how is there any further room to increase this business development in view of several redevelopment opportunities available to us?
Thank you, Bharatji. In terms of the BD pipeline, there is a very strong BD pipeline available with us. But as I mentioned during our earlier interaction on the earnings call, we are very judicious while closing the business development opportunity, and we are doing so for the ongoing transactions. And certainly we are confident of closing the multiple transactions in Pune particularly. And we are evaluating a couple of opportunities also in Bangalore. But over here, I would like to add a few other aspects as well in terms of the inventory available. So currently, as we speak, around 2,100 crore worth sanctioned RERA, received inventories available for sale. On top of that, through priority launches, we are planning to launch additional 3,000 crores worth inventory. So for the remaining of this financial year, so there will be an inventory available for sale in the range of 4,000 to 5,000 crores. On top of that, the next subsequent phases of this already launched or RERA registered sector, there is an additional potential of 3,000 crores. So, 3,007 to 3,800 crores. So in total, we are talking about 8,000 to 9,000 crores worth inventory, even if we don't launch any new locality project. I'm referring to only ongoing projects and their subsequent phases. So to achieve our the guidance, we are pretty confident that we can do it through our existing pipeline itself. But having said that, yes, we are strongly working on the BD pipeline, and there can be couple of announcements in the coming quarter.
Second question, if you can permit.
Yeah. So,
in H1 we have launched worth around 2,000 crore of new launches, and our booking is pre-sales is around 1,300 crore plus. And second half we are looking for 3,300 crore approximately. So is there any upside risk to our pre-sales guidance?
We are confident of matching the guidance. And if you see on quarter-on-quarter basis, whatever the opening inventory available at the beginning of quarter, we could able to sell anywhere between 30 to 45% of the opening inventory of that quarter. So considering that, there can be some positive things, but currently we would like to stick to the guidance given to the given in the earlier interaction. While saying that, we are trying to better the price realization that is quite visible in across our launch projects. So we are continuously trying to better the the per square foot realization. So that is one of the aspects that we are constantly monitoring.
I have one bookkeeping question, but I can I'll take it later on. If you want me to, I can just, it's a small question. Hello?
Yeah, please.
In consolidated debt profile, we are showing this 483 worth of crore of OCD, CCD, or CERP, zero coupon NCD. So what is nature of that and why we are not considering this in our debt, net debt?
These are the NCD instruments, and there is some addition of when we given an exit to ICICI Venture from the township completely. So over there is a redemption of NCD has happened, but since it is a financial liability, over there we have taken a the payment facility of around 2 years. So that financial liability has added that into a 483 bucket.
Okay. Since we are writing is a zero coupon NCD or CCD also, so is there any chances of they are converting into equity?
Sorry, can you please repeat the question? Sorry.
See, here it's a part is mentioned OCD, CCD or OCPRS. So is there any chance that it may be converted into equity later date?
Not at all. So, basically these are, most of it are kind of an inventory transaction, but the flavor of from a documentation perspective, NCD is the flavor, but the spirit of the deal is the inventory transaction. So only commitment from our side is to complete that project in the committed timeline. So beyond that, there is no liability beyond that particular set of projects where we have raised the NCD.
Okay. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Rohit from iThought PMS. Please go ahead.
Hello. Good afternoon, Rahul. So Rahul, just want to understand, I believe in H1 largely all the launches have been in Pune market and very limited launches have been there in Bombay and Bangalore. So two questions here. So in the balance that is about 2.9 million square feet that you're planning to launch now in the second half, are there anything which is going to be launched in Bombay market? And in Bombay, with your existing whatever projects you have, do you have any inventory left or it's largely sold out? If you can just answer this question first.
Rohit, so we have 5 ongoing projects in Mumbai. So out of that, 3 projects are kind of sold out, and 2 projects we have an inventory worth around anywhere between 225 crores to 250 crores. So that is available, RERA registered inventory available. On top of that, we are planning to launch one project that is in Navi Mumbai, which is B3 project. So that launch will happen in Q4, and whatever the BD society redevelopment BD that we have closed in the recent past, so we are targeting the launches of those projects in the first half of next financial year. So to answer your question, in this financial year, the ongoing inventory of 250 crores plus around 300 crores of inventory at Navi Mumbai, Vashi. So that will be available for sale.
Okay, understood. So okay, got it. And this 225 crores would be roughly what percentage of the total value of the inventory? Like, just wanted to get a sense how much of it is sold in these 2 projects that have the inventory left.
So this is available in 2 projects. Out of that, one project is kind of 40 to 50% sold out, and the other project is around 25% sold out.
Okay. And this was launched when, sir? Like how many quarters back was it launched?
So around 6 months back.
Around 6 months back. Okay. Yeah. Got it. Understood. And the other question I had was on the reported numbers. Now, obviously, I understand that the reported numbers are backward-looking, but just from an overall understanding, because like we have in the past maintained that our EBITDA margin should be around 20 to 25% on a normalized basis. Obviously, depending on which quarter what is getting recognized, there will be some variation. But on I want to understand 2 things. One, from an economics, from a broad business economics point of view, is there any change that we are looking at with the given environment, upwards or downwards towards those EBITDA margin? That was one. And second, in terms of what is happening specifically in this quarter, so is there a way to better understand as people outside the business to sort of so that we can better understand this the volatility or the movement in the margin? The idea is not to sort of ask why the volatility is there. I think you explained that, but just to understand it better, if you can sort of explain or give us sort of help us in that. Those were my 2 questions.
So see, if you see, Rohit, for any real estate company, so since we follow completed contracts method, over their revenue gets recognized at the time of delivery of specific project, at the time of possession of the specific units. So considering the different heights, considering the different project time required to get the construction done, so there can be multiple projects delivery concentrated in one specific quarter, or there can be no deliveries for the remainder of the year. So this is going to be the scenario even going forward. But on the other side, this is from a revenue recognition, the top line perspective. But when we talk about the cost, so there is a multiple part of the cost which is kind of a fixed cost or directly linked to some kind of remuneration, employee cost. So irrespective of your top line, so that cost is getting recognized on a quarter-on-quarter basis. So in order to sustain that, so there has to be some kind of minimum revenue recognition for every quarter to at least achieve a zero profit or the positive number. So there can be, so if your revenue recognition is below that threshold number, certainly the profit will be in the negative. If your revenue recognition is beyond that threshold, there can be a significant jump in EBITDA margins for that specific quarter.
Thank you. Mr. Rohit, may we request you to rejoin the question queue for follow-up questions, as there are several participants waiting for their turn. Our next question is from the line of Dhananjay Kumar Mishra from Sunidhi Securities. Please go ahead.
Thanks for the opportunity and congratulations for healthy operating performance. So just wanted to know in terms of Bengaluru market, as we mentioned that we are going to create BD with the revenue potential of 1,000 crore. So any project we have identified, and because sustenance sales from Bangalore is minuscule or rather almost zero. So what is our plan in near term in Bangalore market, and also in Mumbai market? You said that Vashi will be launched in Q4, and this Goregaon and Mulund will be launched next year, first half, right?
That's correct. So in terms of a Bangalore market, we are planning to launch one project over there. That is a third phase of our ongoing project Raga. So which has a potential of around 150 crores. So we have already applied for RERA, and we are expecting to launch that in next few days. So on top of that, we are evaluating, as I mentioned earlier on this call, we are evaluating couple of other opportunities. One in a horizontal development, plotting and low rises, and the other is a JV opportunity in Bangalore. So, but it will be too early to comment on the closure timeline of the same. And in terms of, you are right, in terms of your Mumbai observation, so B3 will get launched in Q4 and the other BD, recently closed BD will get launched in the first half of next financial year.
And both Goregaon and Mulund, when the phase 2 can be launched right? S2, by S2 FY25.
H1 FY25.
In phase manner, no? Phase 1 will be launched in H1 for the Mulund project.
Yes.
And likewise, Goregaon phase 1 will be launched in H1 and maybe phase 2 will be launched in H2. That is the correct assumption, or it will take some time?
So maybe for Goregaon, it will be a single phase development. But since we have two projects over there, so we are planning to have a different set of inventory for these two projects. But in terms of Mulund project, so it depends on what kind of sales velocity we are achieving. So it will be a judicious call to launch the subsequent phases based on the performance of the first phase.
Thank you. Our next question is from the line of Himanshu Upadhyay from O3 PMS. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir. Please go ahead.
Yeah, Rahul, it's a slightly longer question. The question is, if we look at FY19, in that FY19 we did a sales of around 2.7 million square feet, okay? And out of which 35% was Life Republic. So nearly 1 million square feet of sales was from Life Republic, and outside Life Republic we did 1.7 million square feet. If we look at the trailing 4 quarters, so nearly 5 years, because that was the complete year what we can refer to FY19. So out of 4, if we see, the rough cut 65% is from Life Republic. Okay. So nearly 2.5 million square feet of our sales is from Life Republic. And outside Life Republic, our sales is only 1.5 million square feet. Okay. So even if we have tried to diversify ourselves in number of products and business development, it has not yet shown in our sales numbers. Okay. Any reason, or what are your thoughts on that? How should I look at it? Is it because we don't have inventory at various other places and hence Life Republic became such a dominant product for us? Or you think somewhere I am making an error in my judgment or understanding? Some of your thoughts will be helpful for my clarity.
So, Himanshu, there are two perspectives to answer. So, first perspective is we used to sell around 400 to 500 crores of yearly numbers at Township. So, because as I mentioned in our earlier interaction, so we have already surpassed the inflection point of Township. Now, Township is a supermarket of multiple products. So, all the hard works we are getting now the benefits out of that. And because of that, we could achieve this significantly higher numbers at Township. And so, if you talk about the H1 of this financial year, so close to 800 crores of sales we have already achieved in Township with a much better price realization as compared to FY19 or FY20 or for that matter even FY21. So there is a constant effort to better our margins with the improved volumes and value at Township. Having said that, at the same time, we are working on multiple, the projects in Pune beyond Township. So if you see the priority launches, though in terms of the value, the Township, you will see the value of around 3,800 crores and the other Pune projects will be valued at, say, 2,700 crores. But these are a mid-sized project where the turnaround can happen in 2 to 3 years from a sales perspective, whereas township projects, whatever the sectors that we are planning to launch or already launched, these are the big sectors. So by launching this, the other priority launches beyond township, I'm confident that there is a good diversification possible through our current inventory itself. On top of that, we are working on the multiple BDO opportunities. So couple of BDO opportunities that we have already closed, and we are working on 3-4 more opportunities. So when I talk about the opportunities, we are simultaneously working on the approval. So there will be some kind of, the positive delta for projects beyond township. So certainly reliance, so our endeavor is to minimize our reliance on a township, but at the same time we want to ensure that there is a better and better margin realization at the township also with the sustained volumes.
Okay.
And by FY25 we are anticipating a 30% of diversification beyond Pune, and out of 70, in fact, our volumes from township, we want to have that around, say, 45 to 50%, not beyond that.
Okay. See, second question is also related to this only. See, if we look at the first half, Bombay and Bangalore did a combined sales of 62 crore and 6 crores, okay, in Q2 FY24. And we have only an inventory of 0.33 million square feet, ongoing and unsold inventory in Mumbai and Bangalore. The question is, if we want to get the diversification of 30% outside Pune inventory or sales, what type of unsold ongoing inventory should we be having so that we start getting yearly sales of, let's say, means around 600 to 700 crores, okay? And can we achieve that target in next 2 years? Because if we look at 0.33 million square feet of inventory, and it seems very low, okay? And one more thing, this is also at the company level. So at 4 million square feet is what we sold in last 4 quarters, and 3 million square feet is unsold inventory at the company level also. But my priority would be more on Bombay and Bangalore, if you can reply.
So, Himanshu, in terms of a Mumbai top line potential, so that is mentioned in our project portfolio slide. So we have a project worth around 3,700 crores. So out of that, see the difference difference between Pune and Mumbai projects is, in most of our Mumbai projects, we have achieved, I'm referring to a recent past, we have achieved a sales turnaround or complete sold out tag within, say, 3 to 5 quarters. Against that, for a Pune project, since it is a bigger project, in terms of the aggregate inventory, it will look like on a higher side. What I give a comparison between Life Republic and Pune. So similar comparison is applicable between Pune as a entity and Mumbai as an entity. So Mumbai, even if the inventory potential is on a lower side, but the turnaround potential is quicker as compared to Pune project. So considering that, we are confident of achieving around 25 to 30% of diversification in FY25. And just to give you a few examples, so 3 projects that I just mentioned where the sold out tag is achieved in around 3 to 5 quarters in Mumbai. So and similar kind of responses we are anticipating for our subsequent launches also. So even in the ongoing projects, so 50% of that project is sold out in say around 4 to 5 months. So we are confident of getting a sold out tag in another 6 months. So even if we could able to launch inventory worth say 1,500, hypothetically I am telling you, just to strengthen my statement. So we are confident of achieving a significant sales number out of that.
Thank you, sir. Mr. Upadhyay, may we request you to return to the question queue for any follow-up questions. Thank you. Our next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity, Rahul. Just first question on, we have done almost 2,000 crore odd of launches in first half. How much did that contribute to our, first half sales of roughly, 1,400 crores, 1,300 crores?
So around 55% of our sales achieved was through the recent launches.
This is for first half?
Yes, this is about the first half. Around 750 crores, 700 to 750 crores.
Okay, got it. And in terms of the balance launches that are lined up, 3,300 odd crore, are we 100% confident on these launches coming through, or there might be, few of them which might spill over to next year?
Pritesh, we are confident about our priority launches. So particularly about the Pune launches. And even in Life Republic, there can be a deviation in the sectors, but we are confident of achieving a sales number through township. Because as I mentioned earlier, so we have the environment clearances available for multiple projects. So it is a matter of, 45 days to launch any new sector in township for us. So I'm confident.
Got it. And just last, since this Bangalore Raga 3 has been there in our pipeline since very long, and we have been sold out. So probably we were waiting for some approvals where there was some delays. That also can be launched, this year?
So Pritesh, we have already applied for RERA for Raga 3 project. So that project will get launched in next 15 to 20 days.
Sure, that's great. Sound good. I'll jump back in queue for further questions. All the best. And happy Diwali to you, your team in advance, you and your team. Yeah.
Thank you.
Thank you. Our next question is from the line of Avish Jain from Antique Stock Broking. Please go ahead.
Yeah, hi. Good afternoon. So my first question is, so you reported losses during the quarter.
Mr. Jain, may we request you to use your handset, sir? Your audio is not clear.
Yeah, am I audible?
Hello?
Hello, am I audible?
Yes, sir. Please go ahead.
Yeah. So my first question is, you reported losses during the quarter. So does it mean the projects which got recognized made losses?
Hello? Yeah, Avish.
Hello.
Sorry.
Yeah. So you reported losses during the quarter. So does it mean the projects which got recognized made losses?
So, there is no losses at the project because of the exceptional items at the corporate level. It is showing a loss at the corporate holdco level.
Okay, so what were those exceptional items? Could you throw some light on that?
Hi, Avish, this is Dipti. So as we mentioned in the opening remarks also, these losses are mainly on account of impairment of goodwill, which is below the EBITDA level line item, and there is a certain amount up to about 6.5 crores, which is sitting in the other expenses line item. Now this 6.5 crore is mainly on, so it's a one-off land deal that we had done and we reversed it. So what happens when we did a land deal, we had recognized it as a revenue. And now we have reversed that entry and it's now sitting as an expense. So land has come to us. It's not really an expense that we've incurred. It is the land that was earlier sold off and it's showing as revenue is now as an expense because we've acquired the land back and it is showing as inventory in our balance sheet. So this is actually an asset that has been created and not an expense that has been expensed to the P&L. And if you want to understand this in more detail, I'm happy to take this offline.
Okay. Thank you. My next question is, so why has the net debt gone up? So is it due to business development? Hello?
Net debt?
So net debt has gone up during the quarter. So is it due to the business development?
Not actually. It is just a marginal increase in the net debt. So earlier it was 17 crores. So now it is a 50 crores. So not on account of a business development opportunity.
Thank you, sir. Mr. Jain, may we request you to return to the question queue for follow-up questions, please? Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, we request you to restrict questions to one or two per participant. Should you have a follow-up question, we would request you to rejoin the question queue. Thank you. Our next question is from the line of Ronald Sioni from Sharekhan Limited. Please go ahead.
Yeah. Good afternoon, sir. Sir, I had one question in particular with respect to the launches and business development. So, was it a conscious decision by the management that, we need to slow down for a quarter or two or delay a few launches or new business developments in order to, clear some of the inventory? Or is it just a timeline that, it got delayed somehow with respect to launches and business developments?
So it is not about any kind of, strategy. So it is as per our, the planned timeline. So these launches are anticipated and we are planning as per our, the earlier agreed timelines internally. So we have already launched around 2,000 crores worth project. And as I mentioned earlier, so we got a very good response in terms of sales from our recently launched project, and we are anticipating a similar response for the upcoming launches also. So there is no holdback strategy, particularly about the priority launch pipeline.
Okay. Great to hear that, sir. And congratulations on good set of moves.
Thank you.
Thank you. Our next question is from the line of Deepak Purswani from Swan Investments. Please go ahead.
Hi, sir. So just wanted to check it out in terms of the cash flow movement. In first half, we generated an operating cash flow of 182 crores, and in the investment activity, there is a outflow to the extent of 418 crores. So, in terms of the year as a whole, how should we look into these cash flow numbers, particularly related to the collection, construction cost, and new investment in the business development for the whole year as a whole?
Hi Deepak. So collections, we are anticipating collections upwards of 2,000 crore for FY2024.
Okay. And in terms of the construction costs?
We are expecting a collection of close to 21 to 2,200 crores. And against that, our construction cost will be anywhere between 700 to 800 crores.
Okay. And in terms of the business development activity, how much have we spent so far in the first half, and what is the overall investment we are looking at for this year as a whole?
From a BD perspective, we have invested around 350 crores as of now in H1. And going forward also, there can be a investment to the tune of similar number.
Thank you. Mr. Paswani, we request you to rejoin the question queue for follow-up questions. Thank you. Our next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. In the first half, we have seen out of the 5 projects that we have launched, 3 have been in the 24K, category, which is a relatively premium category of ours. So how is the demand in the premium category of houses? And, going forward, how do we see our future pipeline which is there? How many of the projects will be launched in the 24K category, and how much in the remaining categories that we have?
We have launched couple of projects, 24K projects recently. In fact, 3 projects. So just to tell you, 24K is our in-house developed premium luxury brand. So under which we have already delivered around 5 projects in last 10 years. Against that, we are planning to launch 5 projects in this financial year itself. Out of that, we have already launched 3 projects. One project is at Baner. So whatever the inventory that we have launched, around 60% of that inventory is already sold out. In terms of the second project, which got very recently, it is though we have received the RERA, but it is currently in a pre-launch stage. So over there, we have already achieved good sales traction to the tune of around 20% of the the entire inventory available. And the third project, that is a premium row house development at Township, which again got launched in the month of July and August. So over there, around 25% of inventory is sold out. So we are getting a good responses for this project. In terms of, even if we are charging a good hefty price premium, but customers feedback, the referral sales is very good, particularly in this premium category. So that is a positive sign, and that is a motivation to launch more and more premium projects further. In order to talk about the further pipeline, so one project at NIBM, so we are planning to launch that project under 24K umbrella, and we are evaluating one project at Township, that is R5 under 24K umbrella in the remainder of this financial year.
So how are the margins in this segment compared to our normal projects that we have? What are the margin differentials between the two?
See, there are multiple parameters, Ankit, to answer this question. So one is, we generally evaluate any opportunities from 3-4 perspectives. One is a pure absolute margin, second is the IRR, third is the payback time, and the risk, the sales velocity. But having said that, in terms of margin, certainly there is a margin difference of 5 to 7% visible as compared to any of our regular projects and 24K project.
Thank you. Mr. Gupta, may we request you to rejoin the question queue for follow-up questions. Thank you. Our next question is from the line of Shreyans Mehta from Equirus. Please go ahead.
Yeah, congrats on a great set of numbers. So my first question is, as far as our LR is concerned, so if I see, in one...
May we request you to use your handset, sir? Your audio is not clear.
Is it better now?
Yes, sir. There is a slight echo, sir. Please go ahead.
Sure. So, sir, my first question pertains to LR. So, if I see 1H, we are closer to 800 odd crores, and FY23 work, LR itself are closer to 1,000 odd crores. So, you're almost...
So, your audio is not clear, sir. May we request you to use your handset, please?
Yeah, sure. Is it better now?
No, sir. It's still muffled, sir.
So, then I guess I'll return with you.
Yes, sir, please. Thank you.
Okay.
Our next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, firstly, if you could provide a guidance on deliveries for next year and for FY26. For FY24, you are given 1,500 crores. What would that be for FY25 and 26?
Rishikesh, we are confident of matching our guidance for the the ongoing financial year. And next year, we are envisaging the deliveries around 2,000 crores worth projects. And since we are working on multiple low-rise horizontal development also, like row houses and some kind of a plotting development, so it will be too early to comment on the delivery numbers for FY26. But certainly it will be the upwards of 2,000 crores in FY26 as well.
Okay. And how do you see the reported EBITDA margin for H2 and going ahead in FY25?
So, Rishikesh, so whatever the inventory that we have sold around 3 years back is getting now recognized into revenue. So at that time, our price point was, around 5,400, 5,500. So considering that, so we are anticipating a similar kind of, EBITDA margin number that we have reported for the last financial year. And for FY26 onwards, our EBITDA margins will be, there will be a significant betterment in EBITDA margins. Considering that currently we are sitting with a EBITDA margins of around 25 to 30% at the project level.
Okay, got it. Thank you.
Thank you. Our next question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead, sir.
Hi, thank you for once again. See, Rahul, can you give a little more color on the redevelopment opportunities available in Mumbai and also on the cluster development since, but all these, whatever concession has been given are getting expired on 31st March 24, sorry. So how do we see, because so far we have not spoken much on this pipeline?
So, Bharatji, see, all Mumbai projects currently that we have closed are society redevelopment projects.
Correct.
So, over here, the best part is your upfront investment. We have created a very strong brand equity, particularly in society redevelopment. Over there, Goregaon acquisition of new two projects at Goregaon is a live example of that. Since we are delivering one successful project in the same vicinity, we got two more projects at a better terms as compared to the competition and with the better commercial terms also with a minimal upfront investment. So having said that, so over here, though the absolute margins are limited, there is a limited upside, but in terms of the IRRs, in terms of the capital churning out, so it is a very good proposition that we are finding for Mumbai redevelopment. And to answer your second part of question, that is on cluster redevelopment, so we are evaluating couple of opportunities since whatever the opportunities that we have already closed, so it was not a cluster redevelopment. So, but currently we are evaluating couple of opportunities. So, it will be difficult to take the advantage of current, the 50% concession scheme available till FY24 end.
Development side, I am looking. Hello.
Sorry, sir, your question was not clear. May we request you to repeat the question?
Sorry. So, my question, Rahul, was on the business development. One is this cluster development and standalone also opportunity if available.
So we are evaluating. We are open for multiple opportunities in Mumbai. But see, if you see our, redevelopment guideline given to our team, that we should have the top line potential of at least 300 to 400 crores with a ticket size possibility anywhere between 1.5 to 3.5 CR. So if any project is fitting in this criteria, so we are happy to evaluate these projects. And currently, when we are evaluating, say, 25 projects, when we have applied to tender on 25 projects, our success rate is around 5 projects out of those 25 will be, carried forward for the advanced level of discussion. And out of that, we are confident of closing 3 projects. So at any moment of time, our team is evaluating anywhere between 20 to 30 projects.
Thank you. We move to the next question. The next question is from the line of Harsh Beria from who's an professional investor. Please go ahead.
Hello, sir. My first question is about our Life Republic project. So the question is about our land bank at Life Republic. Is this fully paid off? And do we own 100% of this land bank?
Yeah. Harsh, very happy to share one thing that very recently we have, purchased a minority stake of 5% in this township. For that, we have got some kind of, the payment schedule. So once that is cleared and once some partial payment of ICICI Venture is cleared, so in total around 125 crores numbers. So post that, entire township will be owned by Kolte-Patil developers.
That is great, sir. So the point of this question was also thinking from a bit longer term perspective. So let's say 3, 4, 5 years down the line, whenever we sell houses, it will be at much, much higher cost than today. So does that mean it is possible in a 5-6 year time frame for our EBITDA margins to start crossing 30% because our gross margins will really improve?
Harsh, it will be too early to comment on this, but let me give you that kind of confidence that even today also at the township projects, we are confident of crossing a EBITDA margin. So R31, even the R13. So over there, our EBITDA margins are upward of say, 28 to 35% and even a 40% for a low-rise development.
Thank you. We move to the next question. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead, sir.
Thanks for the opportunity. Sir, in one of the previous questions, you had told that, our margins during FY24 are expected to remain around 13-14% what we had reported in FY23 because of, projects which we had bookings in last 3 years. So, we have seen that with many developers that, the projects which are now getting completed and handed over and their revenues and profitability is getting recognized and the margins have been lower because of higher raw material prices. So going forward, how do we look at, there can be instances where, the bookings are done and raw material prices increase further from here on. So which can impact our margins in our existing projects also. So how do we ensure that, these things, like we
Sorry
do...
to interrupt, Mr. Ankit Gupta. May we request you to repeat your question, sir? Your line was not clear in between, sir.
Yeah. So what I was saying is, the margins which are getting reported for the projects which had been executed, for which booking had been done 2-3 years back, are at lower operating margins because of increase in raw material prices. So how do we ensure that the existing bookings of the projects which are getting launched do not suffer from the same issue when their revenues and profitability gets recognized 2-3 years going forward? So, and how do we make sure that, the raw material prices are getting, or any up getting factored in the margins?
So, Ankit, to answer your question, so particularly from a cost perspective, so, since we have judiciously launching a limited phases of any project so that because we are getting a good response at the time of launch itself and the cost will get incurred in 3-4 years for that specific project. Considering that we are, limiting our launch phases for, even if we are confident of getting a good response, so we are limiting the size of the phases for any launch. That is one. The second is particularly on the cost side that we are working out and we have worked out on multiple procurement items with a long-range contracts where the prices have been locked, frozen for 4 to 8 quarters. So that has given us a stability in terms of our cost, escalations or deviations. So, and we are confident of achieving our desired cost numbers, even if we have to spend that in next 2-3 years. On top of that, generally when we are getting a better response in terms of sales, so there is an inventory pricing strategy that we are, implemented in last 4-5 quarters. So over there, once the 25% inventory sold out, we jack up the prices. Then again the prices are getting jacked up at 50% and 75% against the business plan numbers. So in fact, we are bettering our price realizations against the business plan numbers. So that is the additional delta available to compensate any unforeseen, risk, particularly from a cost side.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I now hand the conference over to the management for closing comments.
Thank you once again for your interest and support. We will continue to stay engaged, and if you have any further questions, please feel free to reach out to Dipti Rajput at Kolte-Patil Developers. Look forward to interacting with you next quarter. Wish you all and your nears and dears ones once again a happy Diwali.
Thank you. On behalf of Kolte-Patil Developers Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.